Chapter 5. The Rise of the Bankers. When money stopped being a relationship and became a system. In the last chapter, we saw how lending used to be deeply moralized, viewed through the lens of charity, power, and religious duty. But as cities grew, trade expanded, and empires needed financing, something shifted. What began as a spiritual warning slowly became an economic necessity. And so emerged a new kind of figure in society. The banker. Not a priest. Not a merchant. Not a ruler. But a new kind of middleman, one who didn't just move goods, but moved trust. And as the banker rose, the soul of money began to disappear. 1. From temples to trade halls. In ancient societies, money was often tied to temples. Giving, sharing, and even forgiving debts were spiritual acts. But in medieval Italy, especially in Venice, Florence, and Genoa, merchant families began building new systems. They invented bills of exchange, double-entry bookkeeping, merchant banks. These tools allowed them to lend across borders, track complex debts, and scale credit without carrying gold. Suddenly, lending wasn't just tolerated, it became essential to trade. The Medici family in Florence used banking to build an empire, funding art, war, and even popes. And other families followed suit. 2. Why the rules started to change. As economic power shifted from church to capital, moral arguments lost ground to market logic. Lending was no longer seen as an act of greed but of innovation. The Protestant Reformation helped too. Reformers like John Calvin believed that wealth could show God's blessing, and interest could be charged ethically, if it wasn't exploitative. Now, charging interest didn't stain your soul, it strengthened your bank. The soul was being slowly replaced by the spreadsheet. 3. The institutionalization of profit. With interest normalized, money became a product. You didn't just lend to help. You lent to grow. You lent to make money off other people's money. Banks began creating financial instruments, not just holding deposits, but lending credit, buying and selling debt, speculating on futures. We stopped asking, should we do this? And started asking, can we profit from this? Banking became less about humans and more about mechanisms. 4. What got lost? The rise of the banker brought efficiency, expansion, globalization, innovation. But it also brought abstraction. Money lost its human face. Distance, lenders no longer knew the borrowers. Detachment, responsibility faded into systems. Before, if you hurt someone with a loan, they were your neighbor. Now they were a line in your ledger. Money became colder, and the system preferred it that way. 5. The double standard. It's worth noting, many of the bankers who rose in this era were Christian, even though usury had only recently been a mortal sin. Meanwhile, Jews were still blamed and hated for being moneylenders, even as Christian banks expanded global finance. So the stigma remained for Jews, but the profits moved to Christian Europe. This hypocrisy shaped centuries of myth and policy, some of which still echo in our unconscious narratives today. 6. Bankers and the modern mind. As banks grew more powerful, they became invisible architects of society. They funded kings and wars. They shaped colonial trade. They picked winners and losers. Yet most people couldn't explain how banks worked, even as their lives were governed by loans, fees, interest, and credit. The banker no longer sat in a shop on the corner. The banker became a system. Final thought. There was a time when lending was a question of character. Now it's a question of code. That's not all bad. Modern economies need credit to function. But we should ask, is the banker still a person? Or just a profit machine? Is the system serving people, or just perpetuating itself? Because somewhere in the rise of the banker, we stopped asking whether money was moral. And maybe it's time we asked again. Chapter 6. Capitalism and Conscience.